Okie dokie. Okie dokie, everyone. Can I start off by saying either a good morning or good afternoon or even a good evening, depending on where you are around the world. Welcome and thank you for joining me on tonight's ladies episode of the webinar series I've been doing called How I. And tonight's episode is called How I Learned Correlations and Introduction to Hedging, written by myself, James Trescothick, who is the Chief Trading Educator here at Stratton Markets. Now, before we get on to tonight's agenda and a little bit of an introduction on myself, of course, I'm going to be discussing online trading, CFD trading. And with every type of investment, it does indeed carry a great deal of risk. So I do suggest you do your own research and your own due diligence and know the risks at hand before entering any trade. Now, this plump, hairy, wrinkly fellow is myself. Like I said, my name is James Trescothick, and I'm the Chief Trading Educator here at Stratton Markets. Now, a little bit about myself. I've been in the financial service industry for about 20 years now. I actually started off at the age of 18, and believe it or not, I'm now 40. Yes, that good-looking man's a 40-year-old, not a 50-year-old. So like I said, I've been in the sort of financial service industry for a very long time. I actually started off as a mortgage broker, where I specialized in commercial mortgages before moving into pensions, alternative investments, and then I got involved on online trading and etc. I've actually traded myself. I traded through Dubai Gold and Commodity Exchange, where I traded gold options, and I've ran several floors before moving into portfolio management, and then later on down the line, of course, now sort of education. I'm indeed a published writer, and I've been published in several leading industry publications, including the likes of the Financial Times Advisor, quoted in Market Watch, which is like the Wall Street Journal, and several other, high-profile magazines, newspapers, and financial websites. I'm very passionate about this market. I am an avid market commentator. And one of my many roles used to be, I used to comment on what I saw was going on in the market and share my opinion. And I'm also a well-known public speaker. I've spoken around a number of events around the world, including the likes of Dubai, Kuwait, Qatar, Singapore, Berlin, London, more recently, Joburg and Pretoria and Cape Town in South Africa. So I do get around a bit. Now, as an educator, I will say this, okay? I have got a good, amount of knowledge and years of experience in this field. Like I said, I've been actually in trading for about 13 years, okay? And though I've got a fair bit of experience and knowledge, what I don't do, like other educators out there, is I don't call myself an expert, okay? Because the reason why I say that is I don't believe an expert actually exists, okay? What I do instead is I share with you my experiences and my knowledge, my mistakes, as well as my successes, with the idea that you take this information away, which I'm sharing with you, and you'll form your own knowledge, wisdom, and education on this market. For some of you, I hope this sort of stuff will help you build your own strategy in your own way you tackle the market. But also at the same time, I hope for those who aren't right for trading, it opens your eyes up and actually this isn't for me, because trading isn't for everybody. So I do try and take a very honest, down the ground. God, I don't know what I'm speaking about. Level grounded information as I try and educate. Now, tonight's agenda, let me put myself on here as well so you get to see my ugly mug. Here we go. Hello, everyone. Okay. Now, tonight's agenda, is, like I say, about correlations, and I will be doing an introduction into hedging. So tonight, we'll start off with what is correlations, an explanation of what does that actually mean. Then I'll be discussing currency pairs that correlate and why they possibly correlate together. Then I'll be doing a brief introduction into hedging. Okay. I will do a special live webinar just for hedging later down the line for maybe a next episode of How I series. But we'll do an introduction into hedging. Then we'll go into future educational events I'll be running in December. And of course, my usual question and answer session, which I would hold off to the end. So any questions you have, please feel free to ask me at the end of this presentation. So what is correlation? What does it actually mean? Now, the official definition is it's a mutual relationship or connection between two or more things. Well, that sounds pretty interesting, James, but what does that actually mean in relation to trading? Well, it means this. Whoops, pressed the wrong button. There we go. Always the way, isn't it? Technical stuff, eh? God, I can't even do it myself, right? Anyway, correlation in relation to currency pairs. Now, when it comes to currency pairs, there tends to be two types of correlations. A positive correlation, and this is where two or more assets can increase or decrease in value parallel together. Okay, that's positive. Negative correlations, which is where two assets or more can decrease or increase in the opposing directions for one another. Simply saying you can have one asset go up, and at the same time as that asset's going up, another asset's going down. That's a negative correlation. Positive correlation is you've got one asset going up and an asset follows it, goes up at the same time. That's a positive correlation. So there are two differences, the positive and the negative, and what we'll be talking about. Now, traders, to try and help them identify possible trading opportunities, they look for what's known as correlations coefficiency. And basically what it is, they try and calculate how closely a pair is linked with each other, both in a positive and negative correlation with each other. Okay. Now, the theory is, okay, again, this is a calculation. You have like a level of a negative correlation and you have a positive correlation. The balance number is 0 and the maximum or the best negative correlation is -1 and the best positive correlation is +1. So the idea is the closer it is to either a -1 means it's a strong negative correlation, or if it's closest to a +1 means it's a strong positive correlation. Now, to look at these correlations and work out the statistic to get to the numbers. Sorry for a little dry, I need my cup of tea. Typical English, I need my tea. Now, to look at this, you look at what's known as correlation tables. And there is a lot out there which you can look at, and they can alternate, obviously, as the market goes. It's not something you need to obviously calculate yourself, though you can through an Excel sheet, but the calculations is very complicated. So it's easier to look at other correlation tables out there, and there's quite a few out there. If you Google correlation tables, then you get to see, where the pairs, how are they positive or negative, or how close they are being too strongly negatively correlated, or how strongly to a positive correlated they are. Now, this is a table which I put together from various sources, from lots of data sources out there on the net, from some very, very good brokers out there, such as Staxo, etc., like that. And this is, sort of correlation table you can look at to see if a currency pair is positively correlated and how strong it is, or how negative a currency pair is correlated to another and how strong that negative correlation is. Now, remember, -1 is the strongest negative correlation and +1 is the strongest positive correlation. So let's have a look at this table here we've got here. So obviously you've got Aussie dollar, Euro Swiss franc, Euro sterling, Euro yen, Euro dollar, British pound dollar, USD Japanese yen, and gold. Okay, and across we've got the same pairs across. These are just the ones I randomly chosen, okay, just to illustrate what we're talking about. But you can find correlation tables out for pretty much any pairs you're looking at. Now, remember, +1, very strong positive correlation. -1, very strong negative correlation. Okay, so as we can see, if we go across the top, this is some of the data, average data taken from the 23rd of November, so it's quite up to date. Okay, so you have the Aussie dollar, which is, okay, it's 0.72, so close to +1, is currently positively correlated with Euro Swiss. Again, round about the strong with the euro yen. Very strong currently at the moment with the euro dollar. See, that's 0.888, so it's just under the -1. Pound dollar, as you can see, the cable 0.7047, etc. The Japanese yen is negative correlated, is minus 0.5, so close to that -1. So ones we really need to be looking at is how the biggest or the largest the numbers are. So obviously we're looking at 0.72. So the euro Swiss franc, again, is strongly positively correlated with the Aussie dollar. And if we then look for a strong negative correlation, we've got the euro British pound, which is minus 0.8588, which is a strong negative correlation with the British pound Japanese yen, and so on and so on. Now, these tables are really, really good. Okay, and they give you a good idea. And like I say, a number of these tables update on a regular basis to show you the positive and the negative correlation, how strong those correlations currently are. Now, let's have a look at some some actual charts and see these currency pairs working or going together in a sort of direction you want to be looking at. Now, here's a positive correlation. Here's an example. Again, we got the euro dollar and we got the euro Japanese yen. And if we actually go back to our chart, euro yen, euro dollar, again, pretty strongly correlated in a positive way. So 0.6823. So you know, pretty strongly correlated. So we actually look at our chart movements. These are both daily, taken yesterday. You can see they tend to move in unison. Negative direction for the euro dollar, and we can then see it was indeed a negative direction for the euro yen. When the euro dollar started to move positively upwards, you saw the Japanese yen do something similar, the euro yen that is, do something similar. So again, you can see these two are positive correlated and they're moving pretty much closely or similar in the same sort of similar direction. Let's look at another example. The British pound US dollar and the euro British pound. Surprisingly, this is a negative correlation. It makes perfect sense. Of course, if we have a look at the table again, what the number of the euro, what's the British pound was against the euro, they go euro sterling, of course, minus 0.6251. So again, we have got quite a negative correlation there. So we have a look at what happens here with our charts. So we have the British pound, US dollar, or the cable, and the euro sterling. British pound falls against the US dollar, and guess what? It goes up in the opposite direction, negative correlation with the euro sterling. It recovers and starts gaining ground again against the US dollar, and surprise, surprise, the euro falls against the sterling. As you can see again, the pound drops against the dollar, and of course, as we can see in this line here, obviously, the euro then goes up against the sterling. Now, of course, these correlations make a lot of sense because obviously it's the euro against the sterling. So if the sterling's gaining strength against the dollar, then theoretically speaking, it should be gaining strength against the euro. So this is why we tend to see a negative correlation on this pair. If we do another example, so it's the euro dollar Swiss franc. Let's have a quick look at our correlation table again. So the euro dollar, here we go, Swiss franc, 0.8982. So currently a positive correlation. Let's have a look at our chart and see what it does. An example of our chart here. Let's pull them up. The euro dollar becomes under pressure, as we can see there, and the euro Swiss goes in the same direction. We see the euro dollar starts to recover slightly there, and the euro Swiss franc also recovers. Again, that makes a perfect sense because obviously it's the strength of the euro. So if the euro is going up in value against the dollar, the chances are, because it's a positively correlated, it will go up in value against the Swiss franc. Now let's have a look at another negative, and this is actually a very interesting negative pair. Negative correlated pair. It does actually have a fair bit of interest. Here's the euro sterling, and here's the British pound Japanese yen. This time, when our previous charts were daily, I've actually done 30 minutes. So we pull up our correlation table again. So we have obviously the euro British pound, and very strong currently negative correlation, minus 0.8588. So a strong negative correlation. So we have a look at our chart here, see what happens. Big drop here over the euro sterling. And what happens with the British pound Japanese yen? bounces up very strongly against it. So the British pound gets stronger against the yen. Then you see, obviously, whereas the euro pound starts to recover in strength, the British pound Japanese yen starts to weaken. Again, you see, this is a beautiful candle here. Look, this is maybe a 30-minute candle. The euro British pound drops dramatically, and the British pound Japanese yen rebounds and gains strength pretty quick. Again, that's a lovely little color in there. So again, this is a quite an interesting negative correlated pair. Now, like I say, this is going to be a brief introduction to hedging because I will do a specialized webinar in hedging at a later date. But because we're talking about correlations, and the reason why people sometimes look at correlation to currency pairs is because it can actually help as a possible hedging technique. Now, hedging, basically, best way to think of it is that hedging is like taking out an insurance policy against your trade. It is not, and I repeat, it is not a method to prevent a negative trade from occurring. It is instead an attempt to limit the exposure of that negative trade on your account. Now, every trader out there, this is an interesting way of tackling trading, is because everybody out there knows that it's impossible, absolutely impossible, no matter how good a trader you are or think you are, you will have losing trades. There is no way around it. You will have losing trades. And every trader worth their weight in gold knows that the only way to succeed, okay, is by controlling your exposure of your account and controlling your losses, okay? And hedging is a good way of doing that. Now, when it comes to ideally in hedging, really, one of the best ways of hedging is obviously trading options. I'm not talking about binary. God, no, I don't like binary. Okay, I'm talking about proper options. I'm talking about vanilla options. Okay, and vanilla options are a very good way of hedging your trades, either by trading options on its own and doing techniques like the straddle. So when you buy a put and you buy a call, so I buy a put and buy a call, or taking out an option when you're against the CFD trade, for example. But as we're discussing CFD trading, there is a few ways of looking at how you can possibly trade or hedge using CFDs. And like I say, this is just an introduction. I will do a proper webinar on some techniques later down the line. But, the way to look at hedging with Forex CFDs is, again, this is why we're discussing correlations, is because you look at the correlations and you can look at both the negative and positive correlations and then act accordingly. For example, we had that pair we looked at 30 minutes ago, which was the euro sterling and the British pound Japanese yen, very strongly negative correlated. So one technique you could try or could do as an example, okay, this is not advice, I'm just explaining it to you. Remember, this is never advice, this is educational purposes only. But for example, because that's a very negative correlated pair, if you say you had a euro sterling long position in the market, okay, you wanted to protect yourself because we know that pair is negative correlated. And we know maybe there was a big news announcement coming up, like Mario Draghi was about to speak, or maybe something was happening in relation to the BRIC exit, which, just face it, stuff with the BRIC exit happens on a regular basis. So there we go. So what you could do to protect your long euro sterling position, what you could do, you could, for example, protect your exposure by doing a smaller long British pound Japanese yen position, as these two pairs are negatively correlated. So say, for example, you really believed, okay, the euro sterling was going up, okay, and that was what you believed, and that's what your analysis said. Okay, so say, for example, you did one lot on the euro sterling, because then there's a big announcement coming up. To protect yourself, okay, you would also then do a long, but maybe half a lot this time, on the euro yen. So even if you were losing on the euro sterling, the euro yen would gain, which means you'll be protecting some of your exposure on that trade. It wouldn't wipe it out necessarily, but it would protect it if that trade went against you. At the same time, say that trade went in your favor and you made on the euro sterling, you'd obviously make, because of one lot instead of a half a lot on the euro Japanese yen, of course, obviously you would overcome or pay over for the losses, etc. Okay, so that's one way of basically looking at doing it. The other way of doing correlations, for example, say for example, you had the euro dollar pair, and we know the euro dollar pair is say correlated with euro yen, positively correlated. So we're looking at our chart, and we got the euro dollar approaching a key resistance. Okay, meaning in other words, that might be a potential interesting pair to short. Okay, at the same time, our euro yen, okay, is approaching a potential support. Okay, so like I say, we could do a little bit of a trade with that, where, for example, if they're approaching similar levels, we'll go long on the euro dollar if it could break that resistance, and obviously then long on the euro yen. And that would be an interesting way of doing a positive correlations as well. But of course, remember, hedging is not always perfect, okay? Because especially with CFDs, because obviously the spread and the volatility, okay, it doesn't always perfectly work, because the markets at the end of the day aren't always exactly how we expect. And remember, hedging is for protection, and it's to try and control your losses. Okay, there is other hedging techniques like using obviously swaps and things like that. Things like that we will discuss later in a different session. But anyway, this is just an introduction and possibly looking how to do CFD Forex hedging with correlations. Up and coming educational events coming up very, very soon for December anyway. On the 1st of December, I'm doing part 2 of an earlier episode I did called How I Came to Understand Price Action. This is part 2. Then on the 11th of December, I'm going to do an episode called How I Came to Understand Candlestick Patterns. That, for your technical people out there, will be great, because I'll be talking about candlestick patterns, falling star, hammer, and band and baby, which is always a funny name, but, you know, we sound quite brutal, but it is indeed a candlestick pattern. So that'll be on the 11th of December. Then on the 18th of December, as the holiday season is approaching, I'm doing one more for the year, which is called How I Came to Understand the Santa Rally and Other Fundamentals. And that one, I will discuss the phenomenon of the Santa Rally in relation to stocks and the stock market, and how it sometimes works and doesn't work. And at the same time, I'll be talking about fundamentals in trading as well. And again, I like fundamentals, because when I started out with gold trading, I used fundamentals a lot. Now, that's the December schedule. Now, if you wish to speak to me, by all means, you can email me at james@strattonmarkets.com, or you can even follow me on my Twitter account, which is @jtruscothic. You can direct message me. Obviously, I don't give any sort of advice on my Twitter, but I do talk about market events and give people heads up. So by all means, come and follow me or bother me on Twitter. Before I move on to questions, etc., remember, I have been talking about online and CFD trading. Now, like with every type of investment, it does indeed carry a great deal of risk. So I do suggest you do your own research and your own due diligence, and know the risks at hand before entering any trade. With that out of the way, please go ahead and ask me any questions in relation to tonight's presentation, or maybe anything in particular, anything personal. I might answer, I might not. But by all means, ask me any questions, and if I know the answer, I certainly will share it with you. Any questions at all? Did everybody find it at least interesting or enjoyable? Did we enjoy it? Anybody enjoy it? Or is my voice, so everybody's sick of my voice already? Yeah, shut up, James. Go on, go away now. I've had enough of you. No? Honestly, I won't buy it. Well, I have a question here. This is Robert. Okay. No, okay, Robert, you did enjoy it. Thank you, Robert. You found it interesting. Thank you. I appreciate that. I appreciate people asking questions, because when I'm on my own doing this, it gets quite lonely. I have a question for you out there, actually. Okay. If you have no questions in relation to the correlation or to the presentation I did today, is there any topic in the future you would like me to cover? Any area you like me to discuss? I don't know, maybe Bollinger Bands or stochastics or anything like that. Or maybe you might even want me to do maybe a case study on an asset, on gold or WTI oil, anything like that. No. Is there any area at all? No? Okay, well, look, if there is any questions later down the line, which maybe you suddenly thought, actually, I wish I asked that question, don't forget, you can or obviously indeed email me at james@strattonmarkets.com or follow me at Twitter at jtriscotic. Like I say, write to me. Always, like I say, give feedback. If there's something else you want me to cover or anything like that, please feel free to let me know. On that note, can I just say, I wish every single one of you, thank you so much for joining me tonight and taking the time out of your busy schedule to listen to me and go through today's presentation. What I will say is, like I say, please tune in for next ones and let me know. Till next time, can I wish every single one of you either a good morning or a good afternoon or even a good evening, depending on where you are around the world. Till next time, every single one of you, trade safe.